I'm Greg Hunter. Welcome to USAWatchdog.com. With us, a return visit for guests we haven't had on in a while, and I've had people on intentionally to talk about the economy in gold because I think we're at a big turning point. I'm talking about Andrew Maguire, internationally recognized, renowned gold expert. His website, AndrewMaguireGoldTrading.com. Andrew Maguire, thank you for joining us today from across the pond.
Really good to be with you, Greg.
I want to talk a little bit about what's going on with, where are we right now? Can you give us a recap of where are we sitting right now in terms of the global economy, gold, silver, precious metals, the debt, reset? Where are we right now?
Goodness me, yeah, great subject. Well, look, I think the best place to start, Greg, it's been 10 years since the financial crisis, and we see interest rates remaining at record lows, below zero in many countries, and clearly central planners have got it wrong. And it isn't rocket science to deduce the banking system is broken. So with the wheels coming off the central planners' wagon and deeper negative interest rates on the horizon, is it any surprise we see the IMF trial ballooning, dividing the monetary base into two separate currencies now, cash and electronic money? I mean, this is an insult to injury. Electronic money trading alongside cash would allow the central banks to implement negative interest rates much deeper without triggering large-scale substitutions to cash. And just let's put that into context, Greg. $200 trillion of global assets already have zero intrinsic value. That includes cash, bonds, shares, paper claims on physical assets such as gold and silver. And I mean, 32 trillion of M1 has zero intrinsic value. Now, these are markets where unlimited quantities of synthetic supply can be created, bought, borrowed, sold without any constraints. And that brings us onto the subject, which, as you just mentioned, gold, tangible safe havens. I mean, those could include land, property, infrastructure, but really gold and silver are the most fungible of those intrinsic assets, of those safe haven assets, tangible assets. So, I know we just had a quick chat before, but in 2 weeks from today, less than 2 weeks from today, the Bank of International Settlements will formally reclassify physical gold as a cash equivalent. Now, the implications, I know not everyone gets this, but the implications are enormous. Bottom line, we're going to see the physical market dog starting to wag the paper market tail. Now, that may not seem like a big deal to a paper-centric trader, but believe me, it is. And as a wholesaler, we know what's coming down the pipe. And at this very same moment, we're approaching a time where gold production supply is tightening. So, before looking at the lessening influence of the paper market and how that's going to affect the gold market and the effect of Basel III rules are going to have on the price of gold, let's start by just discussing some basic fundamentals. Now, last October, TD Research, Toronto Dominion Research, reported that attributable gold reserves have declined by 50%. Fact. And that's over the last 5 years. Now, from a wholesale market perspective, we see this number as actually very conservative. This means there's an incentive for producers to build up their gold reserves into a tightening physical supply. Now, this is a rock and a hard place for the synthetic players. Now, for example, Goldcorp, they're not alone in projecting a 20% reserve growth target, as are the other big producers. What does this mean? It means that around 20% less annual global production will come to market for sale from the big producers. Now, as wholesalers, we're on the ball with this. We see this coming down the pipe. So essentially what's going to happen, we move from a situation where almost all forward production was historically sold forward or hedged to a situation where producers are building reserves for no other reason than to capitalize on higher prices. Now, the market-making bullion banks fully understand the implications of peak gold and tightening supply into an escalating global physical demand. Now, physical demand really is the operative word. And Greg, we all know that a lot of the US-centric traders just view gold as a paper instrument that never ever no one ever takes delivery of. So now we're looking at, the published data. I mean, we'll just look at what's there in front of our faces. Published data from 2018 reports central banks added 715 tons to their reserves. Why? I mean, that's just what's reported. However, it does not include the PBOC, Central Bank of China, additions of monetary gold, which we know flow directly into the coffers of the state-held banks. Now, we would estimate these holdings to be triple the 8,133.5 tons of official US holdings. So, really, let's look at the effect, if you wish, of producers withholding production and the price of gold and the cost of production, which, we have to look at these things. And I think it's time sometimes to drill into the weeds. We're gold guys here. What we're looking at is where's the price going to be? What are the big players doing? The big banks, all the big players are accumulating physical. All-in costs for a producer factor in the cost of producing gold over the life cycle of a mine. So people look short-term, hey, it's 850, 950, 1,000, 1,200, whatever, 1,300 for some mines. But by withholding current production, it actually tightens this supply, which, given we are evidencing robust physical demand, what is considered to be cheap gold raises the offer price. So I'm just going to sum up with one thing. The fact is, with gold synthetically diluted to a price that we saw last week, sub 1,300, which is ludicrous, large-sized buyers, including sovereigns and central banks, figure it is more cost-effective to mine paper gold and convert it into physical than to dig it out of the ground. This is modern-day alchemy, Greg.
Where are they buying the gold?
The gold that's going into this, obviously what we have reported is what's on the table is the 715 ton from last year. We're seeing probably 60, 70, 100 tons a month continuing to flow out. But what's not reported, of course, is the monetary gold that is on flights out of London directly into, as I say, the state-held banks in China. And really, let's think about this. If there's 20-odd thousand tons, which we would estimate to be very conservative, maybe even 25,000 tons. Okay, so they don't appear on the PBOC's balance sheet. What would it take for it to appear on the balance sheet? A keystroke. These state-held banks, the key is they're state-held banks. And any time that that China wishes to employ a backing to their currency, which may be coming down the pipe soon, then all they have to do is then literally allocate that into PBOC reserves. So it's interesting times.
Are we getting set up for a reset? I mean, the obvious thing, I want to go back to this Basel III because I've asked a variety of people. Some people, Catherine Austin Fitz, think it's a big deal. Other people I get, I don't get much. You evidently think it's a big deal. I mean, it's right there in your face. We're going to go from a 50% asset to a 100% valuation for an asset we told you all wasn't worth much, and they're buying it like crazy. I mean, isn't that it, or am I just making this too simple? Isn't the change to 100% tier one asset, April 1st, isn't that a big deal?
It's massive. I think, again, a lot of people trading gold out of university a few years. I mean, let's just wind back for 1 second. Gold was formally demonetized in 1978 at the Jamaica Accord. Before that, it was monetized. Now, 40 years later, Basel III coming to effect, and as you say, in less than 2 weeks from now, will effectively remonetize physical gold. Of course, that's a big deal. While the synthetic players shuffle chips in this siloed CME casino, the insider bullion banks are positioning for higher gold prices. That is it right there. The bottom line is, what are the big boys doing? And although informally accepted by some bullion banks in 2018, before Basel III, there was little distinction between unallocated and allocated gold holdings. Now, if we look at unallocated gold, and I remember talking about this with you once before, we're talking about leverage of up to 1,000 to 1 when you account for
that's right.
Unallocated gold it's served up till the 29th of March as interbank cash collateral. Now, suddenly it won't be. The 600 tons of unallocated gold and 5,000 tons of unallocated silver that are cleared between a daisy chain of LBMA bullion banks. Bear in mind, these are too big to fail banks. Every single day I'm talking about here. And you're talking about those kind of numbers, 600 tons of gold, 5,000 tons of unallocated gold and silver versus 3 to 5 tons of physical that really actually transacts. Now, of course, this unallocated gold will be directly affected by these new rules. So, this is where the rubber meets the road. Unallocated gold and silver will no longer be treated as a cash equivalent. Now, this has massive implications for the price of gold, with both spot gold and silver actually trading as cash pairs, which we know, see, a lot of the US-centric traders fail because they're banned and barred from trading gold in the more liquid foreign exchange markets. Forget that gold and silver are actually just a single pair of a foreign exchange, of a 5 trillion a day foreign exchange market. So, so really what you're saying is you're either long gold and short the dollar, or long dollar, short the gold. And obviously, when you have a position that you're short gold, unallocated gold, and long the dollar now, and that has to be cleared at the end of the day, this is going to expose the clearing banks to shuffling derivative and unallocated gold and silver it really puts them into an unacceptable counterparty risk situation. These are too big to fail banks, taxpayer insured banks. And so, as the global scramble to allocate ensues, it's going to backwash into the synthetic markets. And guess who's holding the bag? It's the synthetic traders. So watch out, guys. It's any wonder that the LBMA are forecasting 1,532 gold for 2019. I mean, Goldman Sachs is projecting 1,400 gold in short order. Why is that? It's all to do. A big section of this, or a big part of this upscaling of valuations is because of Basel III. So, I agree, it is a big deal. And anyone who doesn't get that really doesn't understand the physical market and the leverage involved between unallocated gold and physical gold.
Could this cause some people? Could there be a run on actual physical gold? Could banks be like, oh no, I can't count this unless I have it in my possession. I need my gold. Could we have a run on gold, a collapse of the LBMA and COMEX, because no more paper gold, no more unallocated gold, no more promised gold. I have to have it in my vault, so I need my gold. I mean, could that cause the whole system to come down?
Well, absolutely. You have to. I think we have to look at the two different trading groups here that we talk about. We're talking about position concentration. Position concentration has been in the hands of, as we know, a very small cartel of banks. These banks are separate from what we see in the official, what we call the officially controlled marketplace. Let's face it, that gold and silver, Greg, as we know, are traded as a foreign exchange cross. So, in other words, the central banks globally fully admit that they quote unquote manage the currency crosses, the FX currency crosses, whether it's yen, euro, and there's certain agreements about parameters. Of course, they completely deny that even though gold and silver trade as a currency within that group, that of course they never touch those. This is the one area of FX management which, of course, you would never be involved with, which is absolute rubbish. So we say, let's have a look. The too big to fail banks, they are definitely, I mean, we're seeing the likes of Goldman's, the Citis, all the clearing banks, Standard Bank, Scotiabank, UBS, they're all going long gold. Why is that? It's because they already get the fact that they are, and they're allocating gold for their own house accounts. So who are the other players? It's the official players. So when we say, and we see the Bank of International Settlements have an active gold trading desk, Benoit Gilson runs it. We see disruptive moves often coming in pretty close to end of month options expirations for for the over-the-counter positions, which we think we're almost certain they're exposed to about $1 trillion worth of underwater derivative risk. And that's why once a month we see in the paper markets, we see a wash and rinse cycle. And it's almost inevitable that these guys are it's so important to market this enormous derivative risk. And then you see the price of gold suddenly move back up again, and we've watched this cycle. So we say, okay, Basel III rules are coming in. They're kicking in a few days. Will officials be subject to these same rules? Now, this is the key thing here, because we see it's one thing having the bullion banks allocating long, but if these guys can play the same games, is much going to change? And I mean, perhaps that's what a lot of people are sort of questioning. But I say they're maybe not necessarily on the face of it, but they're agent banks, which they cannot operate without, and that is the too big to fail market-making bully banks, who are privileged to have gold accounts at the Bank of England, and there's only a half a dozen. They will have to be compliant. Now, in addition, competing central banks and sovereigns will demand that physical gold purchased at the London gold fixes actually be in the vaults before they place the orders, much like we see the SGE rules or other physical bullion exchanges require. Now, if this bullion cannot be verified, physical orders will simply flow away from Loco London to the physical exchanges that are compliant, rendering the current price-setting fixes completely obsolete. So, yes, I think that we are going to see let's face it, Greg, what is a reset? A reset is simply marking to market a paper price to market at any price that they feel that is appropriate. And who are going to be the people suffering? People sitting on an unallocated gold position, perhaps on a Friday, we close the market, and on a Monday, the price has now, you've been settled for your unallocated account. By the way, that's not a default. If you read the small print, it says you can be settled for cash at any time. However, the minute that the global market, physical market, sees that unallocated positions are being marked to market at a certain price, physical market will explode. There'll be a gap higher. The offer to sell physical will rise to a point where someone is actually willing to sell it, and such it will be. And you look at something like platinum. People have looked at platinum. Vertical rise. What is that? That is a physically driven short squeeze. And people look at it and go, my God, look at that. It must be speculation. It's not speculation. It's the fact that there was a massive short position, just like in silver, just like in gold, but more so in silver even. And what we're seeing is a relentless drive to cover. And we're going to see a similar sort of situation. So what is that price? Well, Greg, that's anyone's guess. But you're already seeing that the LBMA projecting 1532 for this year.
We might get a gap higher when the rules change. I mean, couldn't we? Couldn't we get a gap higher when they start saying, okay, today's the day we're valuing gold at 100% and you have to have it in your vault?
Yeah, we do, because I think that's why we're seeing the likes of the bullion banks all accruing physical for their own books and already been doing it. We've seen, if you just look at, the thing is that if you look at the COT report, which is basically, a lot of people look at it and go, hey, well, I can see the banks are short, the banks are long. You're seeing one side of a transaction. That is a rigged tool of the insiders, of the CME insider casino. That BIS, that COT report does not factor in the much larger foreign exchange market that occurs over the counter across the rest of the globe and is set in London every day. And so when you're seeing that, you look at that COT report, I tell you what, you can take, what use is half an equation? We're seeing the physical, from a wholesale perspective, we're seeing the physical market explode here. We're seeing the only dilution is synthetic market players getting rinsed of a position. And I think you're right. I think what's going to happen is after the end of March here, and only in a matter of a few days, you're going to see what is the benefit of a higher price it'll suit the bullion banks to have a higher price than a lower price. The only people on the sidelines here defending the dollar is the officials, and I look at the Bank of International Settlements as the central bank of all central banks. They're active in the gold market. At some point, they're going to want a higher price, and we all know why. We talked about all this massive derivative, trillions of dollars of unbacked, zero intrinsic value assets, so-called assets out there in the marketplace. Someone has to settle this stuff. It is definitely not going to be settled without a much higher gold price.
This could be more than what you're talking about, 1,500. I know you have to be conservative, but I mean, if you look at, I mean, and I think I know me Prinz on it, but other people had said that, the global debt, just the global debt went from 160 something, 65 trillion to around 250 trillion dollars. I mean, plus nobody's ever paying this debt back. I mean, I've said this a million times. This debt's not being paid back, folks. If it would have been paid back, they'd have paid back some of it instead of exploding it. So when we have a reset, isn't a lot of this debt going to be deemed unpayable or paid in confetti, whether it's confetti euros or confetti dollars or confetti yuan or confetti yen?
Oh, absolutely, it will. And I mean, and what is a trillion or two or a trillion? I mean, it's electronic money, and we're talking about, again, we were talking about negative interest rates a minute ago. What is electronic money? I mean, you can literally mark anything to market. Now, the only thing you cannot do, I mean, of course, gold is the, as people say, the canary in the coal mine. It is the rock that all other currencies are measured by and have been for 5,000 years, 6,000 years, and will continue to do. So yeah, I think you can. What's to stop you literally creating 2, 3, 5 trillion, whatever it is, to literally settle all the unallocated positions, all the unallocated derivative bets, and to move forward with a higher price. I think it behoves the globe to have a higher gold price.
I mean, some people, Jim Rickards says that gold should be $10,000 an ounce. Other people say if you add all the real money, it's 20,000, 50,000. Who knows what the price is? I mean, you're talking about an exponentially higher price, not $1,500, aren't you?
We certainly are. And, when you think of the implications of that, the average American owns less than an ounce of gold. Perhaps, let's be generous, say an ounce of gold. The average Indian farmer cycling down a dusty plain has kilos of the stuff accrued over the years. So what suddenly happens here when we revalue gold? Who's on the sidelines? The smart money is definitely buying it. I spoke to a Deutsche Bank risk manager, probably the largest risk manager for Deutsche Bank. They've been buying physical gold for quite some time. I'd say for 15, 20 months, probably since 2017, when Basel rules were already implemented to come into play in literally, 2 weeks from now. And it amazes me that people have been blinkered to this massive tectonic event. So yeah, I think there's going to be a bit of a shock, but I certainly think it's part of a central planned move to revalue gold. It has to.
Where do you think the price will go?
That's the one thing.
Ultimately,
I wouldn't want to guess. I mean, you see if you wanted to divide all the U.S. debt into available gold reserves, you'd be talking 50 grand. I mean, it seems a little wild to me. But anyway, the other thing is that gold rehypothecated? I mean, 8,100 odd tons of US gold. There's a lot of suspicion that is actually, it may be there in physical form, but, and I'm sure you wouldn't dare but have it in physical form, but how many ownership claims are on that? And we saw that, if you remember, that it was going to take 7 years for Germany to reclaim their 300 tons of gold. I mean, ludicrous. I mean, what was the issue? We shipped 20 tons of silver on a single flight to India. I mean, you could have done that in a week, let alone 7 years. So this raised a lot of red flags, and we're quite convinced that there's multiple ownership claims on U.S. gold reserves. So how do you settle that? Now that I find, again, that's physical holdings held by other central banks that have been leased and lent out, swapped. How do you settle that? To me, only with a higher gold price. But again, this is wild stuff. This is the Wild West.
The Fed is going to be meeting soon. Are they going to dove out on the dollar, dove out on rates, and tank the dollar?
I would think that that's entirely possible. I know you've got you've got your President Trump looking for a lower dollar. You're looking at, I mean, but most of the globe, I mean, the US relies on the deficit. So, yes, I think bottom line, we have to see a lower dollar. I know that goes against what a lot of people are thinking, but I think so. And again, you know, dollar is measured in terms of gold. As far as we're concerned, the globe is concerned, whether you're a Venezuelan or whether you're in the UK, and there's virtually no physical available on the streets at this point because of Brexit, whether you're in different countries of the world where we've seen the gold price rise against those fiat currencies, the only currency where we haven't seen gold rise is against the US dollar. This is catch-up time. So yeah, of course, against gold, which is the only way I can look at the value of it's worthless. All other cash is worthless. So yes, I would say that that gold, dollar versus gold, has to be a lot lower.
Could we get into a hyperinflation? I mean, this reset, could they just go crazy? I mean, we've never been here before. We've never had this much debt. We've never had this many unpayable bonds. I mean, could we get into a hyperinflation?
Well, I mean, it's. I think we're in uncharted territory. What happens if you do back your currency with gold? What happens even if it means revaluing? That kind of squares the books in a way. There are alternative ways of doing this. So we may see the central banks move from a gold suppression stance to a gold to wanting a higher gold price. So how that affects whether that's hyperinflation, I don't know. What do you think, Greg?
Well, I just think that the debt. If we wanted to fix the debt problem, we would have paid it off, or we would have cut it. Well, they don't want to do that. They didn't pay it off. They exploded it. They didn't cut it. I don't see how we win without either coming up with a new currency. Maybe we have everything all at once. People say it's inflation or deflation. Well, maybe they let a whole series of bonds default on that side and say, okay, we got to prop this up. But there's so much debt out there. I mean, you get a massive deflation and hyperinflation all at the same time. It's absolutely crazy.
Yeah, and talking about a new currency, as you know, we came and talked to you. I came in with the CEO of Kinesis Money some months ago, and we talked about the excitement of launching literally a gold-backed currency, but something that would actually be that would actually function, as opposed to a lot of the. I mean, it's welcome. We're very welcome to see a lot of these gold-backed currencies come into play, but Greg, no one's going to use them unless there is an incentive to use them. Why would I spend my gold when I've got fiat currency in other words, Gresham's law, isn't it? So why would I spend my more precious currency, which I in fact want to save? Why would I spend that if I'm not incentivized to do so? So I think what we were excited about it's an 8-year project where we wanted to, at the same time as Basel III remonetize gold, to actually remonetize gold for the people. And I think I just wanted to sort of mention to you that we've come along a long way. We've raised all the capital we ever needed to do it. It launches shortly. What it's going to do, it brings a really important element to the gold market, which is we digitize gold, put it on the blockchain rails, but add a yield. And I think unless you have a yield, if you add a yield to any asset class, it creates the value. It creates value for that asset class. So, but by attaching a yield to gold and silver bullion, an investor can weigh up the yield attached to gold and silver against all other, as I say, whether it's bonds, stocks, or anything else. And so really, this has massive implications on how gold is going to be valued in the future. So I'm very excited about this, and I think this is actually a one-to-one back physical gold that is in small enough fungible form to be used as an everyday currency. So you could go buy Starbucks, you could buy a Learjet, and so what? This is why I've been backing this project and allowing, out of all the projects out there, this is the one I wanted to back. And what differentiates Kinesis from any other gold-backed currency is that when it's spent, it generates the user or the minter a yield. So I know that we don't have much time, but basically, I really would invite people to come and take ownership of something that is in your hands to take. It costs you nothing. Create a yield for yourself. Have physical gold and silver. Stop trading the COMEX. Stop trading the silver, the gold and silver paper currencies, trying to make a yield. You're going to lose money against the big boys. Why? Because it's a casino. A casino is structured in such a way. Every casino is structured in such a way where 95% of you will lose and 5% of you will win. So that's the structure. So, come and join, get out of the paper market, stop being a part of the problem, become part of the solution, adopt a currency that will provide you a hell of a lot better yield in trading paper, gold and silver, and, be part of the solution. That's what I'm saying.
Last question about silver, because a lot of people love silver. And it's cheap for the common guy to go out and buy himself, a roll of silver coins or 10 silver eagles or whatever, wherever you're living, whatever country you're in. Is silver, I've long heard, do you think silver will go up at least in tandem with gold or go much higher, and why?
Significantly higher.
Why?
It's been in the hands of, I don't know if anyone saw the boom and bust interview I did on Russian television with ex-commissioner, CFTC Commissioner Bart Chilton. This was done late December, I think it was, where we had the very first admission. This should make the industry apologists who denied there was any manipulation in silver, and I'm talking about serious manipulation and concentration of position in silver. It should make them run for the hills. Yeah. Bart Chilton fully acknowledged the fact that J.P. Morgan was given when the Bear Stearns collapse came into being in 2008, that they allowed J.P. Morgan to take a massive concentrated silver position. And furthermore, if you look at that interview, it clearly says it went on for years. Now, that is totally unacceptable. In that period of time, this J.P. Morgan and other bullion banks have again, what they've done is completely suck silver out of the physical silver out of the system. They have a very large concentrated physical position, but what they're using is the concentration of the paper market to continue to build that position. And I think we're going to see, when we talked about platinum a minute ago, take a look at the platinum chart. Please put one up. And you look at that, this is what silver is going to do. It's going to break out. I think $50 is a joke. I think it's going to be substantially higher than that. It's not going to be a question of how you can run into resistance anymore with silver. It's going to be how much physical there is available, what's going to come on the offer. I tell you what, anything that comes on the offer is going to be a hell of a lot higher price when you start to have a run on a price.
That's fun. That's a great way to end. $50 is a joke. It's going to heck of a lot higher. Andrew Maguire, your website, andrewmaguiregoldtrading.com. Will you send me the links for Kinesis? That will explain itself, because you did kind of explain that. You did this months ago, Kinesis, when you were getting ready to launch it. But you were in the process of building it. Now you're getting ready to launch it. Go ahead and send me the links for that. I'll put it in after the interview for you folks watching on YouTube. Go to the USA Watchdog after the interview. Andrew Maguire, the website, andrewmaguiregoldtrading.com. Thank you for joining us today on usawatchdog.com.
Been great to be with you, Greg.